The broadcast is now starting. All attendees are in listen-only mode.
Hey everyone, thanks for joining us for the Wednesday webinar. We have a special guest host for you today. Sean Dekmar is joining us. He is the head trader and founder of DekmarTrades.com. Longtime friend of Trade Ideas and referral partner. He spoke at our event last year. Very happy to have him here today. Hey Sean, how are you doing?
Hey, I'm doing great. Thank you so much for having me, as always.
We're very happy to have you. Let's go ahead and get started.
All right. How's it going, everyone? Today, I want to be diving into the most profitable day trading strategy I know. This is the trading strategy that I use day in and day out. Now, there are many different ways to trade stocks, as you guys can guess. There's going long, there's shorting. Obviously, that's more for day trading or just overall stock trading, but we could do options. We could look for swing trading. There are multiple ways to make money in the stock market. What I want to teach you guys is how I make money in the stock market. How am I able to be a full-time trader the last 4 years? How am I over to clear 6 figures every single year trading stocks? How was I able to make $11,000 today trading stocks? Well, let's dive into this and let's take this step by step and go into exact detail about what I do. So with that being said, what is my strategy? My strategy right here. I break this down into a few different key points and I want to talk about each key point. Each key point is extremely important, and for you guys to learn it is going to be extremely beneficial for you. So what we have here is low float, low risk and high reward, strong support, must hit the spike right away or wait until the next pattern, building higher lows, and last but not least, volume. Each one of these key points is going to help you guys become a better day trader. Now, as I said, there are many different ways to trade stocks. You guys can go long. You guys can short. You guys can play options. You guys can do contracts. You guys can swing plays. You guys can go for dip buys, bounce plays, whatever, scalping. But this is just one technique you guys can add to your bag of tricks. This is one technique that you guys can add to your education. And if you guys really enjoy it, again, you guys can work on it until you perfect it and then go from there. Now, every single trader is going to have a little bit of their unique own strategy. Putting this strategy together is basically from me trading over the past couple of years and really finding what I like and what I dislike. And that's what I really want you guys to learn from this. I don't want anyone to follow exactly what I do. I want you guys to figure out what works best for you. We all have our pros, we all have our cons, we all have strengths, we all have weaknesses. And I want you guys to find, hey, you know what? If you're a great dip buyer, then use some of these techniques to dip buy. If you guys are a little bit late to a spike, then hey, you know what? Use some of these techniques to look to short. Find what you can in this and make sure that you guys come out on top. That's what I want. I want every single trader here being successful. So let's dive into these and let's talk about each point and let's talk about, why it's important for us. So the first thing we have here is low float. Now, what is the float? I always like to give the regular definition, and then I like to give the Dekmar Trades definition. What's the Dekmar Trades definition? It's basically like break it down like if I'm talking to a third grader, right? I'm not calling you guys third graders at all. It's me personally. I like explaining things on a level that you guys can relate to. Make it as simple as possible. Everyone tries to make stock trading so complicated. Everyone makes a stock trading, seeing like, okay, when this moving average crosses this Fibonacci line and we get to this, and we're going to see an EMA pop off. It's like, let's just take a breath. Let's calm down and let's make it as easy as possible for everyone to understand. So what is the float? Because this is the first thing I look at when I'm looking for a stock. What am I looking at when I'm looking at the float? What is the float? So the float is the number of shares actually available for trading. Float is calculated by subtracting closely held shares owned by insiders, employees, and the company's employee stock ownership plan or other major long-term shareholders from the total shares outstanding. So that's the definition of float. But what is the float really, if you want to just break it down as easy as possible? The float is basically the amount of shares that we can trade. It is the shares available to us. It is the supply that we're able to trade. And when you break it down, all we're doing is looking at supply and demand. The lower the float, the bigger the spike can be. And I always like to give the example, and you can think about it for anything. There's many different examples you can think of it. It's just the supply. And if we have a low supply and a high demand, what does that cause? It causes the price to rise. It also causes like chaos, right? Imagine if this was Black Friday. Black Friday, and there's 100 parents in line, and they all promise their kids Xboxes. And you know what? There's only 10 Xboxes in Best Buy. What do you think is going to happen? Those doors are going to open, and it's going to be madness, right? Everyone's going to be storming in. All the parents are going to be like, I need to get my son this Xbox. Everyone's going crazy. Everyone's hitting each other, going wild because you have to get that Xbox. On top of that, Best Buy could jack up the prices of Xbox as well because what? because everyone wants them, so you could raise the price. That's the same exact thing that happens with like gas, right? If you're driving your car and sometimes in the summer, we see prices skyrocketing because there might be a limited supply at the time. And what happens? Prices rise. You guys could think about that movie back in like 1990, Jingle All the Way. If you guys have ever seen that, Arnold Schwarzenegger promised his son that, what is it, Turbo Man, and everyone was going crazy. Again, the low supply and the high demand, it causes, again, chaos. And on top of that, it also raises the price. I also, again, just try to give as many examples as I can. Last year, we had that hurricane in Florida, and I remember people were selling water cases for like $35. My sister lives in Florida, and some guy was outside just selling water cases for like $35, $40. And why? Because no one had water. There's a low supply and a high demand. So with that being said, what happens? The price goes absolutely insane. The price spikes very hard. So when we're looking at stocks, what are we looking for? We're looking for stocks with as low as float as we can, because those are going to spike as big as they can. Now, when we're talking about low float, what is low float? How much is low float? Well, what we like to look for, the craziest spikes are going to be stocks underneath 1 million in float. When we're under 1 million in float, that's when we can go on the biggest rips, the biggest runs, the biggest pops, the biggest spikes. And those are when the stocks can really take on off. And I really just want to give you guys some quick little examples right here. So, stocks that have underneath 1 million float, as you guys can see, this is right from our Trade Ideas account. Stocks that went absolutely insane. Let's see, CERG back in November. Again, I'm just thinking about back in November. You can see CERG right here went from $1 all the way up to $3.80. But you can see back in November right here, it went from $1 all the way up to $9.35. Absolutely insane. As you can see, RKDA, this is under 1 million in float. This stock went from $6 all the way up to $66. Absolutely insane. Absolutely wild. We could be seeing like DCIX, the shipper stock. We're not a huge fan of this play, but at the same time, this stock has gone from $1 all the way up to $28. Imagine just having 1,000 shares. Imagine having $1,300 in your bank account, $1,300 in your trading account, and you find the right stock and it goes all the way up to $28. And within 2 days, you guys are banking $25,000 plus just because the stock has a lower float. You find stocks with lower floats, you guys can make big, big cash. Now, it's very simple, especially with the Trade Idea software, that you guys can be able to make very big money in a very short amount of time using, again, low floats. So low floats is so important for you guys to understand. It's so important that you guys, take full advantage of them. And it's the number one key, or the first start I want to talk about, at least, for this. So let's go with low float. Low float, we just talked about. Little bottom point as well, does not matter underneath $1. So what I see right here is if you have a low float, again, we're looking for anything under 1 million. And I just want to give some examples for you guys so you can really, see my point on how big these low float stocks can run. I'm not talking 20 cents, 25 cents. I'm talking about dollars. And sometimes those big trading supernovas, they get absolutely insane. They get fire underneath them. Penny stock momentum moves into it. And whoo, you can see it in my voice right here. I just love it so much. I get fired up just thinking about it. Can't wait for the next one. And these are the ones that are going to rip and run. Basically, we're looking for under 1 million, but anything under 5 million has that potential to go on that supernova level. Anything under 5 million can really rip big. Anything under 5 million can really go can go very hard. The higher you get in float, the more consistent you are going to get. And what do I mean more consistent? What do I mean by that? Well, basically, if you have a low float stock, you have a much better potential of going straight up. If you have a higher float stock, you have a better chance to, continue to move sideways, kind of like more of an uptrend. So lower the float, bigger the spike, but also more of a dramatic drop. A larger float, we have a more solid climb, but at the same time, what happens is going to have more of a consistent drop. So it's basically like low float, low risk, high reward. But at the same time, low float is high risk, high reward. And we have bigger float, which is going to be less reward, but it's also less risk because it's not going to drop as hard. And this little bottom point right here does not matter under $1 stocks. Under $1 stocks is just one of those things you have to know. If a stock is underneath the dollar mark, you can have around 10, 15 million in float, and it can still run pretty good. But anything above $1, always be searching for around 5 million in float or below. And I do have, a couple examples I can really show you guys from that as well. A lot of the times, as I said, and I just want to make sure you guys get a clear visual. The number one thing when I'm always teaching, when I'm always mentoring, as you can see this stuff fires me up. But, when you have a low float stock, yes, it can go straight up like this. And this can go from $1 all the way up to, $10 and a very very short amount of time. Like this could be in a day. It does come more right back on down. And this could be under, 1 million in float, or that's above 1 million float. So again, if we have under 1 million in float, let's just say this is a 1 million float stock, it can go straight up and straight back down. If we see a stock like this, let's say this stock has 10 million in float, and let's say this is like a 5-day span, guess what happens? It's probably going to come back down in the same exact manner. Stocks that go straight up, just like DCIX right here, go straight up, come straight back down. Stocks that are a little bit bigger in float can be a little bit more consistent and not have as much of a rapid drop. But again, DCIX, you're going to be making a lot more money in a quicker amount of time. If we play RKDA, we're going to be making a quicker amount of money in a quicker amount of time. But if you're late, if you chase, if you don't have discipline, if you let emotions take over, what's going to happen? You are going to get caught, and that's when you're going to lose. But I just really want to start off by showing you guys the power of the float and how much potential these stocks can really bring you by just looking at the low float. So let's move on. Let's talk about my next point other than just the float. And before we actually do that, I want to talk about where you guys can find float. I use Trade Ideas to find float, but you guys can always go to yahoofinance.com. Just click statistics and look right here on float. So you go to yahoofinance.com, type in the stock you want, click statistics, and you guys would be all good, ready to rock and roll. So the next thing I want to talk about is limiting your risk. If we go back right here and we see low floats number 1, boom, check mark, got it. You guys know exactly what it is. We're looking for underneath 5 million in float, bigger the rip. It is a little bit more risk, but it's also a lot more reward. Now we're looking to limit our risk, low risk and high reward, because we know that low float is high risk and high reward. So how do we find the low floats that are low risk and high reward? How great is that? How great is it to find a low risk play with a very high reward towards it? How can we do that? Because over 2018, my winning statistics right now is 76%. That means I win 7 out of 10 times, or 7.6 out of 10 times. So that means I win, and then I would have a loss and a loss. And I'm playing these low float stocks. So how do I have a 70% win rate? How am I winning almost 8 out of 10 times when I trade stocks? And now this is what I like to do. I like to limit my risk with the RSI. Now, the RSI is a very basic and a very simple indicator. It stands for the Relative Strength Index. The Relative Strength Index, developed by J. Wells Wilder, I know everyone's a huge fan of that guy. Again, you don't have to know what that is, or who that is a momentum oscillator that measures the speed and change of price movements. The RSI oscillates between 0 and 100. Traditionally, the RSI is considered overbought when above the 70 and oversold when it's below a 30. Best way to learn this is just to see it, right? I know a lot of us are probably visual learners like myself, and we can go to stockcharts.com. Free software. What's better than free? I don't know. Not too much, because free is great. And what we look right here is right here on stockcharts.com, this very top. And this can help us not only go long, but this can also help us short. And we could see right here, it's already set the way we like it. We have it for a 30 and a 70. That's the default. That's what everyone uses. And we're going to be talking about this later, that we want to use what everyone else uses, because that's where psychological play comes in. I'm a big fan of learning about psychology. I'm a big fan of learning how other people are going to react to stocks, because if we can predict what everyone else is thinking, that's how we are going to be successful in the market. And you might have watched some of my other webinars. You guys may have watched some of my other videos. But when you guys, learn how everyone else is trading, you will be able to predict the market. Because guess what? Stocks move up. Why? Because people are buying them. And stocks move down. Why? Because people are selling them. You have to sit down in your chair every single day and say, not what am I doing today? What is everyone else doing today? Because it doesn't matter what I'm doing today. It doesn't matter what you specifically are doing today. It's matter what the mob, the majority of people are going to be doing. When you figure out what the majority of people are going to be doing, you'll be able to predict the stock market. If there's 100 people in the stock market and we see that at 90 of them, out of that 100, notice that the RSI is oversold right here, or excuse me, overbought when it's above a 70, what are they going to do? They're probably going to sell, and that could be an easy short. And we could say, okay, out of the mob, let's say hypothetically there's 100 people in the stock market, and 70 of them or 80 of them see that the stock is oversold because it's below a 30. What are they going to do? They're going to start buying, and that's going to push the stock up. And if we're on that ride, we'll be able to make money. But the RSI is one of the easiest indicators to see. It's one of the easiest indicators to understand, and it's one of the most predictable, indicators to use to help you on what that stock's going to be doing next. We notice when the stock gets overbought, people sell it on off, and when the stock is oversold, people buy it on up. I get this way too much. How people come up to me and they say, "Deck, I'm buying this stock, What do you think about this play? And a lot of the times it'll be a stock that's just like all the way sitting up here. It'll be a stock with a very long, spike all the way up, like a big long spike all the way up, and it'll be sitting in the top right-hand corner of a chart. You don't want to buy a stock in the top right-hand corner of the chart. It's overbought, right? It's overbought. Does that make sense? I always give you an example. Imagine walking down Wall Street. You're walking down Wall Street, a broker comes up to you and he goes, hey, I'm a broker. I got a great stock. It's been doing excellent. It's up 110%, and you're like, oh, this all sounds great. And then the broker goes, yeah, but it's very overbought. It's going to crash any day now. We don't know when it's exactly going to, but it's going to dump very hard. Hey, you want me to pick you up 1,000 shares? It's like, no, get away from me, you freak. I don't want anything to do with you, right? And that's how you have to think about it. If the stock is overbought, why would we be buying it? If a stock is up here, does it make sense to be buying it with a 70 on the RSI? No, it's just going to dump. If we are oversold, why would we want to be shorting it? People are going to be coming back on in. Now, something we do have to understand, though, as traders is what? Penny stocks are not going to be the most profitable overall businesses. Like when I'm trading my stocks, and again, I trade anything between 25 cents to $25. I'm not just strictly penny stocks. When I say penny stocks, I don't mean just like those 2 stock cents. I don't even play those. I pay 25 cents to $25. That's what I like to look at. And when we're doing this, guys, again, we want to look at the RSI, but a lot of these stocks are going to run out of business. A lot of these plays ultimately are going to fail. They're not good companies. So sometimes something to just keep in the back of your head, when you see a stock oversold, yes, is that a good time to go long? It's definitely a start. There's obviously a lot of other things we're going to want to do. But when we see that the stock is oversold, we do have to understand this stock may ultimately go out of business. Sometimes what happens, people buy into a play, it's oversold, and they just keep holding it. And they keep holding it, and they keep holding it. And what happens? The stock keeps falling, falling, falling. And now, again, your $20 loss is an $80 loss. And now it's 120. And now it's 200. And now it's 500. Now it's 1,000. And you turn into a bag holder. And you're saying, Deck, the stock's oversold. Why did it not come on up? Well, again, you do have to understand a few other things behind this. So first off, we are playing companies. I know we don't look at them as companies sometimes. We look at them as charts. We look at them as just stocks. And we look at them like playing the candles and the psychology behind it. But you guys do have to understand these are real companies and they can go out of business. They may not ever come on up. So whenever you guys buy a stock on the oversold part, make sure there's a reasoning behind it. That could be strong chart support with a low RSI and news, something along those areas. But you don't just want to buy any oversold stock, right? You don't want to just buy any oversold stock because that's not going to do very well for you. So, that is very important. And again, I keep bouncing up towards and giving you guys a few different examples and such, but I do just want to give you guys a free little screener. I'm all about helping out anyone who's willing to learn and anyone who's willing to listen. So if you guys are looking for oversold or overbought stocks, just a little cheat sheet for you guys right here. We'll put that ad down so we're good. And let's click Finviz screener. You go to finviz.com, click screener. Simple enough. Again, whatever stocks you want, price underneath $10 if you guys are, again, more on towards the day trading side. We want to see maybe a little bit of hotter plays. Let's go over 1 million in volume. Click technical. And, we could say, hey, we're shorting some plays. Let's see what stocks are overbought. Okay, so we have one stock right here that are overbought with an 80. That's just, again, really high. We can go with the 70. And if we bring down our volume, we can probably get a lot more plays over 500,000. Oh, we're not really seeing too much right here. Let's try this on the other side. So again, we're not seeing too many stocks overbought right now at all. And this is out of all these penny stocks. Let's go oversold with a 30. Let's see how many penny stocks are oversold at the moment. Whoa, 112. 112 oversold stocks. That means what right now? Summer market conditions. If you guys have been in chat, you guys know summer market conditions are definitely taking over. And look how many stocks are falling right now and not moving on up. August is, again, the slowest month for day traders for the penny stock region. Not saying, options or some of those bigger plays aren't moving well, but again, a lot is. We have 112 oversold stocks out of anything under $10. And overbought wise, we got EKSO. So EKSO, that's the only play right now that is considered overbought with above an 80 on the RSI. And yes, you guys can see, nice rip on here, big upper shadow, possible shorting coming on in, maybe back down to 275 in the near future. Again, just a little heads up for you guys right there. So again, different things to just keep on watching, how the RSI can just, help us find different plays. Just doing that quick little thing, we may have a possible short on our hands, right? Just doing that right there, we may have a possible potential. So what we have here, we have our low float, already went through. Under 5 million, we like to see again, but how can we limit some of the risk of low float? We can always look at the RSI. The RSI helps us a lot, right? So the RSI is going to help us become a better trader. The RSI is going to tell us when to short and when to look long. The RSI is also going to want us to sell and when to cover our short, the 30 and the 70. What else do we have? Strong support. Now this goes along with the RSI as well. We want to have a bottom support, a floorboard, right? So when we have that floorboard, that's going to allow the stock to move on up. And what is basically the opposite? What's the brother of support? What goes hand in hand? Support and resistance. This is stock trading fundamentals. This is stock trading textbook. Build your foundation. This is what you guys definitely need to know. Support and resistance on what it is, how it works, and how you guys can benefit. There is so much psychology behind support and resistance. There is so much you guys can learn from support and resistance. So let's just dive into this really quickly. What is, support and resistance? In stock market technical analysis, TA, support and resistance is a concept that the movement of the price of a security will tend to stop and reverse at a certain predetermined price. These levels are denoted by the multiple touches of price without a breakthrough of the level. So again, Dekmar, help me out here. What the heck did you just say? Give me that third grade definition. Basically, guys, resistance is an area when the stock is coming up to it, it hits a price point and it turns down for some reason. Support is an area when it comes down to it, it hits it and it moves on up. This is all, again, going off of three different things. A, past chart history. B, natural support and resistance. Or C, detailed. Now this is stuff, would be a completely different webinar, but this is what we teach again over at Dekmar Trades, or what I teach again. We go into all these support, natural would be every 25 cents, with the whole numbers and 50-cent marks being the strongest. We would have detailed as the previous high, previous low, close of the day, high of the day, 52-week high, and the indicators, and then past chart history, different areas in the past where it has bounced at and where the stock has, hit up at for resistance. Breakthrough of resistance leads to breakouts. Old resistance turns into new support. I'm kind of going off right here because I want to cram as much in, but easy, visual, Deck, help me out here. Bada boom, what do we have? We have this right here. This is something you need to always understand as a trader. As a trader, what are we always looking at? We're looking for support. As we find our support line, our support is going to bounce up to resistance. When we come back down to support, we come up to resistance. And then when we break resistance, what happens? We break resistance, we shoot on up, we get a breakout, right? You could see a breakout right here. We get our breakout until we hit a new resistance line, either natural, detailed, or past chart history. And then we fall back down and we bounce off of what? Old resistance. Old resistance holds up as new support. How great is that? So basically, every single time we see this breakout happen right here, we know that what? We know that we are going to be buying at the break of resistance, and this old resistance line is going to hold up as our new support line. And then guess what's going to happen over here? We're going to do the same exact thing. This is one of my favorite patterns out there. This is called channeling. And it has led me to make so much money. It has led to so much easy profits. And it's something that, I know the team absolutely loves. So we have easy patterns right here where the stock falls. And this support could be, let's just say it's $2. $2 support right here. And $2 may have bounced before in the past. So $2 support bounced in the past, and we come on up to 250 natural resistance, and we can't break 250, and we can't break 250. Come up to 250, we can't break it. Then we break 250. Guess what happens? Now we rip all the way up to $3. Now we come back down towards around 250, and then we come back up to $3, and we can't break it. And we come back down to 250, and we come up to $3, and then we get a nice break. Support, if we can figure out where support is, our floorboard, we have nothing to worry about, because if we buy next to support, guess what's happening? Either A, let's say, what did we say this mark was? 250, correct? Then all we have to do is put a stop loss at 248, 247, 246. We're risking 4, 5, 6 cents if we buy at support, because if support cracks, it's done, right? If support cracks this line, it's over. If it falls below support, it's done. So we may lose if it falls, but we're only risking 3 to 4 cents for the stock to run 50 cents. And then it breaks through that. Now we're all the way up to $1. So I'm having dollar profit range, and only $4 or $5 stop losses, or 4 or 5 cent stop losses. So I have 1,000 shares, let's say. I'm losing $40 to make, let's say, $1, right? which would be $1,000. How great is that? Or even let's say 50 cents. Let's not give $1. That's, let's say that's a little too much. And then someone's like, oh, that's too much. Okay, let's say 50 cents. You could even say 25 cents if you want to, but you're risking $40, $50, $60, $40, $50, $60 to make $250, $500, $1,000 because I'm buying at support. I'm buying at these bounce plays, or I'm just understanding that we have very strong support at this mark. And I could put a stop loss right here, or even if I buy right here, I know that I have support, right at this bottom area. And I know that the stock can definitely take on off, and I know the stock can definitely move on up. So I'm limiting my risk because I know where support's at, and I'm looking for the breakout. And look how great that is. People always say, how do you not blow up an account? How can you be consistent with your trading? Stick to your game plan. If I know where support's at over and over and over again, and I'm risking $60, 6 cents on 1,000 shares, and I am shooting for, a 30-cent sell target. And let's say I lose my first one. Okay, I lose my first one, I'm down $60. And then, the next day or maybe in the afternoon, I lose again. Okay, now I'm down $120. Okay, and then, I hit my stop loss of 6 cents again, and I lose that one. And then I lose my again, and I lose 4 trades in a row. And, now I'm down a little bit. One trade makes it all back. One trade, one successful trade makes it all back. So now put on top of that when you have a 7 out of 10, 77% win rate, where you're winning, and then every now and then you hit that 6 cent loss. But you could technically lose, win one time, make all your money back. Lose, win one time, make your money back. So if you kind of want to even think about it as kind of like a ladder effect, I know a lot of traders that are successful, real-time traders in real life, full-time traders, that's what I meant to say, who don't have a 50% win. Like they don't win more than 50% of the time, but they have a closer stop losses because they know where support's at. So basically, if we're looking at that and we're playing, that sort of manner, what can we say? Let's say this is where we start at. This is where we start at right here, okay? And let's say we lose our first trade, okay? Boom, we're there. And we lose our second trade. Boom, we're there. And we lose our third trade. Okay, boom, we're there. We lose our fourth trade. Boom, we're there. But then we hit our one. Okay, boom. Now we're bouncing right back up here. Now we win our next one. Boom, now we're here. But then we lose our second one. Then we lose this one. But then we win this one. And now we're all the way up here. And then we lose this one, and we lose this one, and we lose this one, and we lose this one. And we win one. Okay, now we're back to even. Now we win another, and we're all the way here. Then we lose this one and lose this one, but then we win the next one and we're all the way here. Look how even with all these losses, look how many more losses there are than wins, but we're still progressing. We're still growing our account because we're keeping our stop losses tight because we know where support's at, right? This is, again, going off channels. I absolutely love channels. I think channels are one of the best patterns you guys can find. And if you need some examples of it, like this would be a channel pattern in real life. Let's just load up for you guys real quick. And I know I get fired up into it. I can't help it. I'm sorry, guys. I love it. And I want you guys to be able, because I know how much it's changed my life. So I wanted to help you guys as well. So you could see coming on up, hitting support, seeing support there, hitting support, coming back on down, building a higher low, which we're about to talk out, breakout, channel patterns, coming on up, coming down, coming on up, coming down, higher low, breakout. You can see this happens over and over again. All these channel patterns forming, leading to these breakouts. These are what I want you guys to see. This is what I want you guys to understand. It's absolutely beautiful. So let's dive back into this right here, and let's keep this fun going. So we went over low float, low risk. How can we limit our risk with the RSI? On top of that, limiting our risk, we're looking at strong support. We know that old support holds as support, but when we break resistance, that's going to turn into our new support line. Now, let's see what else we have. Must hit the spike right away or wait until we get to the next pattern. So what is that about, right? And this is a picture that I've talked about before. I bring it up all the time in chat. People probably hate me for it because I bring it up so often, but it's so, so crucial. This is a diagram basically of how people, get in on plays. The purple is the early birds, the early swing traders. We're going to have about 2% of people get in on this early. The orange is going to be the breakout traders, the people who know at the break of $2 natural resistance, after we have some resistance there, that we're going to see buying volume move in. And then what started happening? The novice traders, the rookies, the people that say, oh my gosh, we got a stock spiking right now. I got to buy into this because I got to go to Applebee's later, right? We start seeing CYCC pop up, and now it's popping up on the scanners. Everyone's going after it. And then what happens? This leads to chasers. There's a point where the breakout traders turn into the chasers, turn into the rookies, and guess what happens? They get shorted on, they get dumped on, they lose. You ever become one of those traders, especially when you guys are first starting, that says, why does everything I buy turn down on me? Why is it every single time I find a spike, it already spiked, and right when I buy in, it starts falling? Why does that happen? Because again, you're late. You're late to the play. There are 4 out of 5 different areas you can buy and you could be successful. Be in the purple, be in the orange, short that stock down, or be a dip buyer. The only place you cannot be to be successful is a what? A chaser, a rookie, someone who sees the stock happen and then it already, starts falling back on down. Avoid this area. Avoid it. I played this stock and I was in right here. I was like in between an early trader and a breakout trader. And this stock, went on a great rip. I made about $1,200 on this play. Because guess what? If you visually see the stock, visually see the spike, most of the time you're too late. Most of the time this means you guys are chasing. And that's why it's so hard. Why? Because your emotions kick in. Everyone here wants to make $1 million. Everyone here wants to go after it. Everyone here wants to be a full-time trader. I understand. I've been there. But you can't let emotions take over. Now, you guys can see from here, I'm an extremely enthusiastic person. I love what I do. But at the same time, when I'm trading, I don't let my emotions tell me what to do. If a stock has spiked, I say, you know what? That stock spiked. That's absolutely great. That's absolutely awesome. This stock has already went on a move. This stock has already spiked on up. It already went on a climb, right? If the stock already went on a climb, guess what? There's going to be another one in the future. People act like a spike happened and they're never going to see one again. Oh my gosh, that stock spiked so big. I can't believe I missed it. I stink at stock trading. Are you kidding me? There are a million more spikes to come. Steph Curry, again, just because he misses a three-pointer, do you think he's like, coach, take me out, I stink? No, he just goes down again, shoots it, and then he makes it, right? You cannot be emotionally attached to one spike because you miss it. If you miss a spike, give a little clap. Bravo, traders who made their money. Awesome job. Now let's go ahead and find the next one. If you're late to a play, it's not happening. Again, in the great words of Ricky Bobby, if you ain't first, you're last, right? If you ain't first, you're last. I know it's, again, off of a funny movie, but this is how I relate my stock trading, right? Also, chew Big Red. Side note. Okay, so again, if you ain't first, you're last. And that comes down to seeing this. If you're not in on the purple, if you're not in on the orange, guess what? You're probably going to be ending up in the green. Now, sometimes the big thing that hurts traders is what? People see this and they understand it. And they say, Deck, you're 100% right. I've been that chaser. I've been there before. But then what happens? Where does that change? Where people stay disciplined the way they should. And then what happens? A stock comes where they say, I'm not chasing, I'm late. And then the stock goes from $2.50 to $3. And you say, nope, I'm still not chasing. And then it goes from $3 to $4. And you say, wow, this kind of stinks, but I still can't chase. And then it goes from $4 to $5. And you're like, I can't believe I didn't buy in on the stock, right? And those are the ones that stick in your head the most. Even though they don't happen that often, that's the one that sticks in your head the most because you feel like you completely missed out on this. And now what you just learned goes completely out the window. And now on your next trade, you say, hey, I'm chasing on this play. Yeah, Sean told me not to chase here, but the last one, kept going. So you know what? I'm buying in now. And then what happens? The stock turns on you. And now you're saying, why does everyone turn on me? Why does every stock? And now you're getting really emotional. And now you see another stock that's moving on up. And you're like, yeah, I shouldn't buy in this. I know this is chasing, but how about that one that ran all the way up to $5? Oh yeah, we're at $2 right now. No, this could be the one that's go to $5. I'm buying in on it. And then, that's what happens. And that's how people lose, and lose. You guys have to understand that. Do not chase. Something else extremely important in my trading, guys. Volume. Volume, so crucial. So important for you guys to learn. Volume. In the context of a single stock trading on a stock exchange, the volume is commonly reported as the number of shares that is changed hands during a given day. The average volume of security over a long period of time is the total amount traded in that period divided by the length of that period. So, simple definition. Volume basically is how hot the stock is, right? Yes, that is the right definition. And what I'm going to say right now is not the right definition, but it's how I think about it. Basically, volume is how many people I think are on that play. If there's a lot of people playing that stock, obviously the stock has a lot of attention to run. Volume equals activity, and activity equals profit. The more people trading a certain stock means more activity that is going to go to it. If we have 1 million people buying us and selling a stock, that 1 million people could rip that stock all the way up to 1,000%. If you have 10 people playing a stock, guess what's happening? That stock's probably going nowhere. So you need to find a stock that has hot volume, that has a low float, that has a low RSI, and has strong support. That's where we're at so far. Volume is so crucial for you guys to be able to see, for you guys to be able to read. It's a very tough thing to find, because a lot of people do what? A lot of people go to like Yahoo Finance and they see and they look at volume. And they look at volume on Yahoo Finance and they say to themselves, oh, wow, look at this stock. This stock has more volume than its current day or its average. This stock must be really hot. And they go ahead and they check it out and it's really dead. It's not moving at all. What we want to look for is volume at the current moment. The hottest times in the market is from 9:30 to 11, that first hour and a half, and then from 3 to 4, that last hour. That's the hottest times with the most volume. This is prime time trading, that hour and a half and the last hour of the day. This is when we see the majority of our spikes, the majority of our rips, the majority of our big time breakouts. It's because this is when there's the most people in the market. So volume is just how much activity is on this play currently at this time. Now, how can we find volume? How do we know if a stock's hot? Well, there's a couple different ways. We could look at the high of the day momentum scanner. We could look at the time in sales in the level 2, or you could just look at the chart. So what we have here, this is what I love to use. This is one of the easiest ways to find volume, and this is Trade Ideas high of the day momentum scanner. For a stock to hit a high of the day, what does it have to be doing? It has to be moving up. So it must have some sort of activity towards it, correct? So this is one of my favorite scanners that I like to use. And again, I use this all the time. As if a stock is climbing, obviously it's moving on up. And if a stock is moving on up, that means people are buying it. And if people are buying it, it's going to be coming up to a resistance line. And if we're coming up to a resistance line, we are soon to be getting a resistance touch, which either going to lead to a big time drop or a breakout. So the high of the day momentum scanner is one of the easiest ways to tell if a stock's going to be ripping or running, if the stock has a lot of volume, if it has a lot of big time attention, and if it's worth my time. And you can see right here, this is my high of the day momentum scanner, the one I've been working on. And you can see I filtered out by float as well. You can see I put everything in dark blue. That's underneath 1 million in float. So again, I have a high of the day momentum scanner. This comes down, and again, this would be a complete different webinar. I could talk about a high of the day momentum scanners for hours. The count alerts, the volume towards it, how you can register your float, and make it so simple for you to see what stock is moving and which stock you would want to get into. Again, everyone knows all about the 20 counts, right? The 20 counts, absolutely beautiful. So the high of the day momentum scanner shows me what stocks are moving up, what stocks are coming up to resistance. If we see a stock repeatedly hitting the high of the day, like we see over here on the counts, you can see like IFMK came up to 6 different high of the days. We see that's decent, but sometimes we'll see a stock, hit 20, 25, 30, 40, 100, all in a very short amount of time. Obviously, that means there's a ton of volume. There's a ton of hype. There's a ton of attention. So the high of the day momentum scanner is one of the easiest keys for you guys to be successful in finding volume. So make sure you guys get on that. After that, the time in sales, right? The time in sales is an easy way to just tell if volume's coming in, because the time in sales is part of the level 2. The level 2 shows us the bids and the ask. The time in sales show us the orders that have actually gone through. Now, when we look at the time in sales, it's harder to see right now because the day is not currently open. But what we like to look at is basically that time in sales flying. We want to see that time in sales looking like you ever open up a book and you just kind of go like with all the pages. That's what we want to see. We want to see this time in sales ripping through. This time in sales dumping, going crazy. Because the more people trading it, the more we can move. And the more that stock moves, either in the down or upside, the long or short side, that's more money that we could be putting in our pockets. So why would I ever want to play, a completely dead stock? You don't ever want that. The more people playing a stock, the more potential it has to go on a nice rip, the better potential it has to go on a nice spike. The level 2, obviously, that's a lot different, but it's just a heads up, very simple, basic. The time in sales is a very easy way to just be able to read volume. The faster that time in sales has orders going through, the more people trading it, which means, again, more activity, which equals more momentum, which equals more profit. On top of that, where can you see volume? Just look at the chart. Underneath every chart, you always have candles, right? You have these volume bars. And you could see right here, the bigger the spike, the more volume that moves in, right? You can see it's pretty dead right here, not really anything. But then look at these massive volume climbs. Now, this is not really the best way to look at it, because you're going to be late to the party if you wait for this big rip to come in, because that means the stock probably already ripped. So you really want to learn the level 2. The level 2, the time in sales, is the hands down best way for volume. How I find stocks really quickly is the high of the day momentum scanner. Then I put them on my level 2 and I read the level 2. Again, I teach that, and I read the level 2. And then, afterwards, you can always confirm, and, it's very easy to be like, oh, look how much volume the stock had. So, the chart, you're going to be a little bit late. You want to learn a level 2. You have to learn how to read a level 2 if you want to be a successful stock trader. You need to know, just by looking at this right now, if this stock is going to go up or if the stock is going to go down. Everyone, in our members, you guys probably know right now, the stock, right here, if we're just looking at this bid and ask, probably is going to be heading on down, not too much. Again, it's only 400 versus 200, for the size, but, any market order could come in. But again, that's completely different, lesson. But level 2 reading is so important. High of the day momentum scanner, time and sales, and reading the bottom volume bars to just see, how much volume is coming in. What's next? What's the final one that we want to look at right here when we're just talking about my strategy? My strategy. We're on the very last one right here. Volume was it came in first. We have building higher lows, right? So we have our low float. We have our low risk, our high reward from the RSI. We have our strong support. We must hit the spike right away or wait until the next pattern. Again, if you ain't first or last, we went over volume, and now we have building higher lows. Now, what is this? And building higher lows, ladies and gentlemen, is one of the easiest ways to tell that a stock is going to spike. Okay? It's one of the easiest ways to know that a stock is going to be taking on off. It's a dead giveaway that a breakout's coming on up. Okay? So when we look at this, what are higher lows? Higher lows is a slight increase in price without causing a dramatic change in price. It is a slight uprise in price over a few day span after consolidation. Your boy wrote that definition. Pretty simple, right? Basically, what is a higher low? It's just when the stock starts moving its way back on up. So I drew this out. It looks like a third grader drew it out, but make it as easy as possible. What are higher lows? Here you go. Do you got to make stock trading astronomical like this is rocket science? Absolutely not. Make it as simple as possible. This pattern right here, guys, is what you want to look at when you want to be a successful stock trader. And you guys are saying, what are you talking about right here? I'm going to break it down, don't worry. But this little area, this little run up right here is the giveaway that this stock is going to start spiking again. And what this pattern is, I call it a masterpiece pattern. We're going to talk about it in a second, is a big time spike, come on down, support, higher lows leads to a breakout, leads to a rip, leads to a pop. And all the higher lows is a slight increase in price without causing any dramatic change in price. Again, we just basically want a creeping. We don't want any big change, just a little change in price to basically get it on people's radar, basically put it on people's watch list. We're not trying to see the stock spike right now. We just want to see it, setting itself up for a big time move after its consolidation. So consolidation also is basically this bottom right here. It's basically when the stock just doesn't do anything, bounces back and forth between a couple prices, consolidates, and then it moves on up. Just in case you need a kind of a little rundown on consolidation. Crash course right there. So example of low risk, high reward. Again, low RSI, consolidates at the bottom of support for a period of time, and then building higher lows. This is what I like to look for. This is what I like to call a masterpiece. This is beautiful. This looks great. This should be next to the Mona Lisa, right? If I saw this, this is art. I'd pay $20,000 for this piece, okay? I'd hang it up right across my bedroom. My girlfriend would walk in and say, this isn't the most beautiful thing you've ever seen in your life. So what is this right here, guys? What are we looking at when we're looking at this play? This is what you want to look for, or one of the main patterns I like to look for. Now, as I said, again, take me back all the way towards 35 minutes ago when I said there are many different ways to profit in the stock market. This is not the only way. This is just something to put in your bag of tricks, to get in your education, put in your knowledge so you guys are better traders. But what we like to look for is a big time spike in the past. And then it comes back down, it consolidates, builds higher lows, we get a breakout. Okay, let's break it down. Why do we want to see a big time spike? Big time spike means that it can spike. Traders like to see that a stock can spike in the past, right? If a stock has spiked in the past, it can spike again in the future. If we see a stock that has never spiked before, does it get traders excited? No. Traders get excited when they saw, oh my gosh, last time stock ABC has gone from $5 all the way up to, $10 plus. It gets traders excited. If a stock has not gotten up to that and basically has gone from $5 to 502, 2 cents, does that get anyone excited? No. So we like to see the past chart spike. The past chart spike gets people going. It gets people excited. Usually, again, this type of move, straight up, straight down, usually is from a low float as well. So we can assume that this is a lower float. On top of that, we have very strong support across the board with consolidation, and we're low on the RSI. And now we're building higher lows on up. So everything we just went over is right here. We have, again, past chart history pattern, low float spike, past chart history, low support. We have strong support from the consolidation over a period of time, a low RSI, building higher lows. We have low risk of hitting the high of the day, volume coming in now because the stock can't climb without volume. And now we're looking for our spike. I want to give you guys some real-time examples. Not only real-time examples that I dug up out of the archives, real-time examples that happened this week. CARV, are you kidding me? CARV, this stock went from what? $3.75 all the way up to $12. Like, what? Huge. Low float rip, as you can see, straight up, came back on down, massive potential. Just again, take it back for a second. You have $3,000 in your account. I know a lot of you guys have more than that, but let's just say you have 1,000 shares and it goes from $3 all the way up to, $12. And you guys are banking $9,000 in a day. That's the power of Ponsol, baby. The stock market is insane. Imagine if you just have a little bit of larger account. Right now I trade with around $55,000 in my account. I could be buying upwards of 6, 7, 10,000, 15,000 shares if I wanted to. This could change my life. This could, make my whole entire year in a day. I could be making 6 figures if I hold this. But notice what we have, a big time spike. The stock comes on down, consolidates in a period of time for a low RSI, builds some higher lows. We break the 50-day moving average and we get our spike. Let's go back to a second. Everyone get this in your head and boom, let's go here. Pretty similar, right? Pretty similar that we got this spike right here. This is the spike that I'm looking at. This was the spike this week from $4 all the way up to $7, right? Because we saw this monster spike in the past, came back down, low on the low RSI, strong support where 200-day moving average. Stock starts building higher lows. Here's the first low. Here's the second low. Here's the third low. Break of 50-day moving average. Big time spike. Can't tell me that doesn't look alike. Okay, Decky, maybe you just found one lucky one, this week. Okay, boom, XBIO. Big time spike starts coming back down, hits support, low on the RSI, starts building higher lows, break of the 50-day moving average, boom, you get your rip. This was this week as well, XBIO. This is just a pattern that you guys should write down. This is a pattern you guys should print out, get a tattoo of it, anything you want, to make sure that you guys remember it. These are 2 spikes that happened this week alone that have gone on a very nice rip and pop. And guess what? You guys want to see how did I make $11,000 today? I made $11,000 today. How was I able to do that? Well, what play was this? This was just simply going off of BOXL. And guess what? Guess what pattern this was today? BOXL. Boom. What do we have? We have our big spike, comes back on down, builds support, starts building higher lows, spikes on up, right? This was the same exact thing that we have been going over and over. Big spike, low float, comes down, low RSI, builds support, higher low, and we get the nice move all the way from 385 all the way up towards around 550. I know it doesn't look that big right here, but that's a very solid move. Very solid move, very solid rip, very solid activity. And again, I always want to be credible. That's extremely important to me, to always be credible on everything I do. So give me 1 second right here. I just want to move this out of the way here, and you guys can see. Here's from TD Ameritrade, my P&L on the day. P&L on the L on the day, BOXL, $11,000, $11,000 on today. And how did I play that stock? Why did I play that stock? Because BOXL, big time spike, came on down, low RSI, strong support right here from the past, higher low pattern, got our nice pop today. And also, something I want you guys to see is it had a beautiful squeeze on its indicators. Right now, I don't have my indicators up on this pattern, but on these charts, excuse me, but it had a beautiful squeeze on BOXL on this play. And I actually want to switch really quickly because that is important that you guys see this as well. And we're actually going to be talking about this in a second. So I do want to switch. These are my trading trade ideas scanners that I use. So whenever the ones that you were just looking at are my after hour scanners. These are the ones I use for my trading. You see my high of the day momentum scanner. You guys can see my breakout scanner, my Holt scanner, my mid candle breakout scanner. But you can see right here, look at this, right on up, the 50-day moving average, squeezing the 13 EMA. Beautiful pop, beautiful rip right there. Masterpiece pattern. Came back down low on the RSI, build our support, and even watch this maybe for the potential, tomorrow or the next week. Watch for a possible continuation right here. There definitely could be a lot of big time, potential. But I just want to show you guys that. I want to show you guys that on how I was able to make this profit and how I was able to predict it. People say the stock market's not predictable are the people who are not willing to study, the people who aren't willing to put in the work. Saying, how do you know that the stock's going to move on up? I put in my due. I put in my time. I've been trading now for 4.5 years. Was I able to do this for my first month after working? No, not at all. But I did take time, and I was able to figure out what patterns work. Which patterns, again, follow certain psychological moves where people move on in on them, where people buy, where people sell. So you always want to be looking at these. And this is a very easy pattern. So risk versus reward. Never leave a play to 50-50, only when the odds are in your favor. Now, we do want to say, how do we know the odds are in our favor? How do we know the odds are in our favor? Well, you want to go over these 6 steps. So 6 things to remember before going into every single trade. Number 1, how much percentage is the stock up already? Right? Why does this matter? Why do we care? How much is the stock up already, percentage-wise? Because if we buy a stock up 90%, up 100%, up 120%, it has a much better chance to fall back on down than it does to continue to rise, correct? Like if a stock is up already 100%, it's going to fall back on down. I would much rather buy a stock up 10%, up 5%. And then, we could see a nice big rip. If you're about to buy a stock and you're buying it out of the pure fact that it's up, you're probably going to lose. And I show this all the time. Gap ups, crashes. I have so many, again, I work with a lot of different traders. And a lot of the traders, I work with, they all say every single morning, hey, I'm buying this stock. And it's always the number 1 stock on the gap up scanners. And that's usually the worst stock. Why? Because it's already up 100%. Usually the stock that's up 150% at the bell, guess what? Already made its move. And that's why it crashes on down. You can see it goes on up, but then it crashes on down because it already made its move in pre-market. People already traded that stock from $6 to $8.50. It already went from $2.25 to $3.15. It already made this climb. It already made this rip. In today's example, LMFA. LMFA, everyone wanted a piece of LMFA because it went from 40 cents all the way up to 86 cents. And then people are saying, okay, I'm buying it on this. And then what happened? It fell from 80 cents all the way down to 45 cents. Look at over here. Just because a stock is up does not mean it should be one you want to trade. Usually the best plays are the ones that don't have any sort of gap ups, right? You can see down here, the Supernova started with no gap up at all, right? That was a stock that, right here, CREG, this stock went on a nice rip, had no gap up at all. We could look back here, this stock had no gap up at all. Eventually later had a gap up, but the Supernova from 140 all the way up to $7 had no gap up. Because again, it's all buyers. Sellers didn't even get a chance on this at all because again, no one's there to sell because everyone's buying still. So you always want to, again, look for a stock that isn't up already. You don't want to play stocks that already made their move. Play a stock that has yet to make its move so you guys can go ahead and make money. What else do we want to look at here, ladies and gentlemen? We want to be looking at why is the stock spiking, right? First off, we want to say, We don't want to buy a stock if it's up this high, but why is the stock spiking? Why is it even up this high? The stocks have to be credible. There's only two things you can do. Either A, we have a chart pattern, or B, we have news. In penny stocks, there's going to be manipulation. If you don't like it, well, again, that's how it's going to be. There's going to be people that have large accounts. There's going to be people who have, big followings. There's going to be people who, send out email blasts that try to pump stocks. There are rich people out there that can just buy hundreds of thousands of shares and they can manipulate a stock. If you see that happen, guess what? You're probably buying in on a pump, and you're buying in because you emotionally feel like that stock can make you money and you're going to end up losing. Do not buy in on a pump, because if you buy in on a pump, what's going to happen? It's only going to dump, right? A very easy saying. Buy in stocks that have credible reasonings, have news towards them, not just some stock that's moving up on the high of the day momentum scanner that has a low float. That's not what you want. Find a stock with a reasoning, with a press release, with a chart setup. That's what you want to look for. Not just, hey, this stock's moving up. Oh, people are buying in it. Oh my gosh, it just ran 50 cents. I got to buy into it. And the next thing you know, it's dumping on you. Have a reasoning. Next up, what are the market conditions, right? What are the market conditions? You have to think about it. And this is so crucial as well. I know I kind of like to be like, this is so crucial on every point. It really is, because the market changes. And I see the market conditions as like the weather. Because guess what? Some days are really nice and sunny, and some days are going to be raining. Some days could be a beautiful day, go outside and throw the football around, and other days are going to be an absolute blizzard. And if you have an absolute blizzard, you cannot wear, t-shirts and shorts like that, like you're going to have the most amazing day. If you, again, go into a play and you're not in the right market conditions, guess what's going to happen? You're going to lose. You're going to lose, and you're not going to have fun. Imagine it's snowing outside and you run outside in a t-shirt and shorts. Are you going to have fun out there? No, you're going to be freezing. You're like, this stinks. This weather blows. So understand market conditions. Like as we know right now, August for day trading is a little bit slower. It's a little bit on the slower side. So we have to say to ourselves, okay, maybe we should limit our trading a little bit, be more hesitant. Let's limit our shares, lock in our profits when we have them, not chase anything. All things I want to be saying. In the fall, in the winter, in the spring, I might say, hey, let me buy 10,000 shares. Hey, I just ripped 50 cents. Let me go after 75 cents. It's a lot more active. Understand, we go through different phases. And if you trade the same way all year, you're going to have hot points and you're going to have very low points. Very low points. You have to understand the market conditions. Basically, what are you wearing outside? Sometimes the market is going to be very hot. Go ahead and wear a t-shirt and shorts. And sometimes it's going to be very cold. Better bring your big time jacket and snow pants. Next on up, what is the float? We already went over this. But again, we're looking for that low float for reasons you guys already know. What is my game plan? I see so many traders hopping on plays and have no game plan. Have no game plan at all. Where they say, I'm buying in on this. Why? Because everyone else is buying in on this. I'm buying in on this. Why? Because the stock just ran 50 cents. I'm buying in on this because it's moving on up right now. That's not a reasoning. That's not a game plan. A game plan is I'm getting in on this play. I'm entering here. I have a stop loss here, and my sell target is here. I see too many people hopping on plays just because it's moving on up, and right when they get in on it, they start freaking out. Right when they get in on that play, they have no idea what their next move is. Have a game plan. What's your entry? What's your stop loss? What's your sell target? How many shares are you guys going to be buying? These are all things that you guys need to take in consideration. Next up, just the final thing, why am I hopping in on this? Is it worth it? And I've been asking a lot of traders that, throughout the summer, is it worth it? Some people are bored and feel like, hey, I need to trade. I haven't traded yet today. I didn't trade yesterday. Deck, but here comes a little stock starting to move on up. Maybe if it breaks this resistance line, we may be able to see a big time rip. But is it worth it right now? Is there a reason that you're really trading? Are you trading out of boredom? Are you trading out of emotion? Are you trading out of greed? So make sure you ask yourself things. This is what I always like to think before I hop into a trade. And I know, it sounds like a lot, but once you actually get the feel for it, it actually goes by really quick, really quick. Now, I know we're starting to cut close on time, so I am going to go over this last, couple slides a little bit quicker. But again, it's just because diving into this stuff, I know I talk longer than probably I should, but at the same time, I will get through these last little bit. What indicators should you guys be using? What I think you guys should use is the 50-day moving average, the 200-day moving average, and the 13 EMA. These are the top three I think you guys should be using. Now, some people may email me and say, Duck, what about my Bollinger Bands? Duck, what about my, my clouds? Again, you guys can use whatever you want. It's not up to me. You guys are your own traders. These are what I use. I use the 50-day moving average, the 200-day moving average, and the 13 EMA. And I only use 3, and I only use them on the daily chart. I do not use any indicator on the 1-minute chart. I do not use any indicator on the 2-minute, 3-minute, 5-minute, 10-minute. I don't use it on any of that. Why? Again, indicators, guys, all comes down to psychology. That's all it is. That's why we have them. They help us understand where the majority of people are going to buy and sell. Okay? People use so many different indicators and their charts start looking like this, right? They're like, hey, I got, this VWAP going. I got this moving average going. I got this EMA going. I got this cloud going. I got this, MACD going. I got all this. And you're just like, who's ready to trade? Ready to rock and roll? I am. Okay, let's see where we're out here. Where does the stock even start? No one even knows what's going on. So you have to keep it simple. I say pick 3. Pick 3 that you really enjoy. Pick 3 that work out for you the best. And I want to go over why I use these 3. Why I use these 3. Why do I pick these 3 out of all of them? And again, why do I only use them on the daily chart? Well, we'll talk about that as well. So let's start with just the 50-day moving average. The 50-day moving average is a popular technical indicator which investors use to analyze price trends. It is simply a securities average closing price over the last 50 days, and that's from investinganswers.com. Now, what do I want you guys to see out of this? The thing in this definition, again, I didn't write this definition, is a moving average is a popular technical indicator. It's one of the most popular. The 2 most popular moving averages is the 50-day and the 200-day. That means the majority of people are using these indicators. Now, let's go back to hypothetically, there's only 100 people in the stock market. And out of that 100 people, 85 of them are using the 50-day and the 200-day moving average. Guess what? When we come up to the 50-day, when we come up to the 200-day moving average, what's going to happen? That stock's going to sell off because it's going to hit resistance. Those indicators are going to hold as resistance and it's going to fall. When we come down to the 50-day, when we come down to the 200-day moving average, guess what's going to happen? The stock's going to bounce off them. It's going to act as support because out of that 100 people, 85 of them are using this as their indicators. You guys can say, oh, well, I like to use the 213.8 moving average. Okay, you're the only person in the world using that. So if you're selling that as the stock comes up, you're selling for no reason. The only reason we use indicators is to know psychologically where the majority of people are going to buy and sell at. So that's what we want to look at. Look at the 200-day moving average, and this is from Investopedia.com. The 200 simple moving average is considered a key indicator by traders and market analysis for determining the overall long-term trend. The price level in a market that concedes with the 200 SMA is recognized as a major support price is above the SMA or resistance when the price is below the 200 SMA level. So again, what's the main thing right here is considered a key indicator, the most popular indicator and a key indicator. These are the most popular. It doesn't even matter where you guys go. Go to tradingview.com, go to stockcharts.com, go to trade ideas. The first thing by default is always the 50-day and 200-day moving average. You got TD Ameritrade, go. It's always by default. Those are the first 2 that always come up. They're always, on their charts no matter what. And that's what the majority of people are going to use, right? So next on up, what do we have? And this one, again, goes a little bit against the rules, but I'll tell you exactly why in a second. The 13 EMA. The exponential moving average is a weighted moving average that gives more weight or importance to a recent price data than simple moving average. Okay, this part. The 12 and the 26 exponential moving average are often the most popular quoted or analyzed short-term average. Now, I use the 13 EMA. I don't use the 12. It's literally like 0.00001 difference. Like you won't even be able to tell a difference. When I first started trading, I used the 13 EMA because that used to be the most popular, I would say, and I just always stuck with it. But the 13 EMA, or you could just use the 12 EMA if you wanted to, are what? The most popular. So we have the 200-day and 50-day moving average, which is default on everyone's charts, which is going to be extremely popular. And then we out of all the exponential moving averages, the 12 and 26, but again, it used to be a 13. I've just always stuck with the 13, is also the most popular. So this is why I use them. Now, why don't I use them on the 1, 2, 4, 5, whatever minute chart? Because it's too different, right? You're going to have at the start of the day, what's going to happen? You're at the start of the day, you're going to have people using the 1-minute chart, and you're going to have people using the 3-minute chart, and you're going to have people using the 5-minute chart. And every time frame you go to, those indicators are going to be different. Every time frame you go to, every single indicator is going to be different. On a 1-minute chart, the 50-day moving average may be here, and the 200-day moving average is here. Then on the 3-minute chart, the 50 days here, the 1 minute's here. It's too diverse. People are bouncing around too much. But it's always the same on the daily chart. It's always the same on the daily chart. So that's why I don't use it on the 1, 3, 5, any of that. Now, I'm not saying it's wrong if you do use it. I just want to use the majority indicator, the most popular one, because it has the most strength. That's why I use it. It has the most strength. It has the most power. It has the most force. And I use it on the most popular chart, which everyone usually has a daily chart open, right? So everyone always has, some sort of daily chart open. And what we see right here is when I'm trading, I have my daily chart right here, which has the indicators. And then I have, either my 1, 3, 5 minute, as I'm trading. But I always have this right here. And as you guys can see, let's bring this over. Let's bring over, stockcharts.com right here. And you can see stockcharts.com automatically has the 50-day and 200-day moving average up. Now let's go down and add the 13 EMA exponential moving average. Let's go 13, bada boom, because that's what I like to use. And let's look at how this could be very effective. Well, again, what do we have? Well, a lot we could break down just looking at this. First off, what can we be seeing? The 13 EMA is just riding up the chart. Every time it comes down to the 13 EMA, it bounces off of it, right? The 13 EMA is what I like to call the flexible trend line as well. If the stock is on the bullish side of the 13 EMA, you can hold that stock until the stock cracks below. And then you could short that stock when it comes all the way back on down. I'm giving you a little crash course real quick. I know, again, I'm really low on time, but I do want to give you guys a crash course just really quickly because it's so helpful. And again, if anyone's listening, I just want to make sure that you guys are getting your time and getting value in this. Look at the 13 EMA. This is the 13 EMA. We call it the flexible trend line because anything on the top side of it is bullish. Anything on the bearish side of it is a bearish. So obviously, the moment it goes to the bullish side, you can hold this until it cracks underneath. Imagine buying it right here at $22. And even though it goes down, as long as it holds, and then boom, you could sell it right here around $25. So again, got it at 22, sold at 25. Let's say you buy it right here. Buy it at $22. Okay, you're good, you're good, you're good. Oh, big pullback. It's okay. You're good, you're good, you're good. Okay, cracked underneath $31. Just made a $10 profit right there. Now you say you want to short it. Short it at $31. Okay, big drop. Oh, should I, cover it? Nope, you're good, you're good, you're good, you're good, you're good. Okay, get out at $26. Now you're going back to the bullish side. So I mean, the 13 EMA flexible trend line is absolutely beautiful, can help you out so much. Let me get it back to the standard default. And you guys can also look at like BLNK. Now let's just type in BLNK. As we said, the 50-day and 200-day moving average is what moves up, comes up right away. It's the default. And what you guys can see here is what? Notice, why do we like to use this? Because it has the most strength. It's the most popular. And why do we use it? Well, look at this. Comes up to the 200-day moving average, falls. 200-day moving average falls. Why is it randomly falling at this area? Because that's the 200-day moving average. That's why the stock's falling. Now it comes up to the 50-day moving average and it falls, right? It comes up to the 50-day moving average. It falls back on down. This is holding up as very tough resistance, right? You break through resistance right here, you get big spikes. But when you come up to resistance and you can't break through it, it holds up as a wall. These indicators are, again, very important. 13 EMA, 200-day moving average, 50-day moving average. So crucial, so important. And I'm telling you, use the most popular indicators on the daily chart as they are going to help you become, better traders. They're going to be able to help you predict the stock market more. They're going to be able to help you guys become or be able to make more profit simply enough just because you guys are using the right time frame on your indicators and using the most popular ones. So these are all different, things that you guys can add to your education, going through my strategy. And again, just want to recap that really quickly. My strategy, what is it? Low float, underneath 5 million, low risk, again, low RSI, strong support. Again, we want to find that floorboard, must hit the spike first, or again, we go get the next one, building higher lows and that volume to move on in, right? We want to see that volume move on in. Different ways to find volume. Here's your masterpiece chart. That's what you guys want to see for the masterpiece chart right there. That's how, again, I was able to make $11,000. That's how CARV spiked. That's how XBIO spiked. That's how BOXL started spiking. These are 6 things you want to remember before every single trade, and these are the indicators that you guys want to be using as they are the most popular. Again, if you guys are using indicators that aren't very popular, guess what? They're not going to really be having that much of a force behind them. On top of that, I just want to say thank you so much for everyone who joined us for this webinar. I know I get a little crazy, get a little enthusiastic. That's just the way I am, guys. I just love what I do. I love teaching. I love helping everyone out. Little side note, I am doing a small account challenge this fall. So I'm very pumped to be doing that. I'll be doing it on tradecaster.com, which is a new site that all traders are able to log on to. It's absolutely free. Watch live streaming, and you guys can live stream your trade. It's not launched yet. It's actually launching in the fall, but I am doing a small account challenge. Last time I did a small account challenge, I turned $4,000 into $80,000. So we'll see what I can do this year. Also, again, right now, I do this every single day at deckmartrades.com. When you guys sign up at deckmartrades.com, you get a free 2-week trial. I live stream, I commentate throughout the whole entire day. I love it so much. And on top of that, guys, you guys can follow me on social media, Instagram, Facebook, Twitter, all at deckmartrades. So I just, again, want to say thank you so much for everyone who joined us today. And I'm so fired up that Trade Ideas was able to invite me, be able to do another webinar for you guys, and I hopefully can see you in chat. So again, Scott, you can take it away. And again, thank you so much.
All right, fantastic. Thank you, Sean. Thanks so much for everyone for attending. We're gonna, yeah, okay. So it looks like the recording went in fine. So we'll have that converted and up a little bit later tonight. Look out for an email with the link to that replay. And Sean, I'll send you that download too shortly. Thanks all. Any questions? Just shoot us an email, info@trade-ideas.com, or you can reach out. Sean, what's the best email for them to get you?
Deckmartrades at gmail.com.
Deckmartrades@gmail.com. And you want to give out your Twitter?
Yeah, everything's at Deckmartrades. Instagram at Deckmartrades, Twitter at Deckmartrades, Facebook at Deckmartrades.
Perfect. That makes it easy. All right. Thanks again, Sean. And like I mentioned, we'll get the recording up as soon as we can. Thanks, guys.
All right. Thank you, guys.
Later.